Okay, let's ease into it a little bit. You guys still with me?
Yep.
I'm going to try to share my screen with you here. Do you see something that looks like the midterm?
I do.
Okay, well, this is the actual midterm, so don't copy anything down. So just an update on where we're at. So we're into week 4 here. You guys have completed your first tax problem, and you do have a score for that now if I've done everything correctly. So you should be able to check that out. And we will have a midterm that will be due this weekend, so Saturday evening. It's a decent chunk of the grade, I guess. So what you can expect here is I'm just kind of scrolling through. We have 10 multiple choice questions, and these are fairly equivalent in level of difficulty to the practice midterm that I gave you that we'll spend a little more time talking about tonight as well. And then there's some true-false questions. These are tricky just because things can sometimes hinge on a single word. And so if you get in a hurry with the true-false, you can know something and accidentally make a mistake. So go slow with those. There are 20 of those, or excuse me, 10 of those. So 10 multiple choice, 10 true false. And then there is this essay question about de minimis fringe benefits. And then there is this essay question about the earned income tax credit. And then there's this short answer essay question about effective and marginal tax rates. And then there's a thing here about the individual tax formula. So that's what to expect. That's what's coming your direction. You will have 3 hours to do it. And so I think now, you kind of know what to expect, and you can narrow your studying a little bit so that you can zero in and be successful on that. So let me go back to the home page here. I wanted to, I don't know, many of you probably saw it already, but I added a little video on retirement plans in week 3. And then here is the sample midterm that I don't necessarily feel like we need to talk about every question, but I thought I would highlight a couple of them. Number 2 is kind of a useful one. There are these questions about included and excluded items, and we know that if you have life insurance and you get $50,000 from a life insurance policy, that is excluded or is not taxable. But here's a case where Miss Grant is receiving those payments over time, and she's going to get 10 installments, so $50,000 divided by 10 would be $5,000 a payment, per payment, but she's getting $6,800 because they're increasing the amount to give her earnings because she's taking the payments over time. And so in this case, the amount that's in excess of the $5,000 or the $1,800 is actually included in interest income. So that's, and there's a little piece in the chapter on income, included items that goes through how to calculate these annuities and these insurance situations where part of the payment is excluded, but part of the payment is included. You'll have a few questions like this number 2 with Mrs. Grant that are a little bit tougher where you've got to apply or calculate some things. And then you'll have some that are more definitional like 5, like which of the following can be deducted to arrive at AGI. So at AGI is different than from AGI. So to arrive at AGI, that's above the line. And so the above the line deductions, well, it wouldn't be medical expenses because that's Schedule A. So it looks like it's probably B because alimony is deductible to arrive at AGI. Charitable contributions and non-reimbursed business expenses are also on the Schedule A. So you'll get kind of this mix of things where you might have to do a small calculation or you might have to connect a few dots, and then you'll get these other questions that are sort of, do you have a sense of the bigger picture? There's no matching or any checkbox questions on our midterm, but this is a great problem here. Things that are included and excluded. So interest on municipal bonds is excluded. Alimony income is generally included. Child support is excluded. Death benefits from life insurance is excluded. Unemployment compensation, unfortunately, is included. Stock dividends, just skip that one. That's just weird. Scholarships for tuition and books would be excluded. Bonuses would be included. Winnings from gambling would be included in income. Scholarships for room and board would be included in income. Income from illegal activities you have to pay taxes on, so that's included. Inheritances would be excluded. Tips from bartending are included. All tips are actually included. Welfare payments would be excluded. And then prizes and awards would be included. And so that's, again, we won't necessarily have a problem like that, but that's just sort of a quick review of that included versus excluded decision that we have to make a lot. True, false questions. Dividends from stock are classified as passive. That's false. That's portfolio income. So we break down income into three categories. We have earned income, which is like W-2 and self-employment income. We have portfolio income, which is interest income, dividends, qualified dividends, and capital gains from stock sales. So that would be portfolio income. And then passive income would be income. Generally, the common one here is real estate. So dividends are not passive, they're portfolio, and so that makes 21 false. Charitable contributions to public agencies are only deductible to 30% of the AGI. That's actually false. It's 50% if you've been following along with the reading. And then when your gross income is less than the combination of your standard deduction and your exemption, you never have to file a tax return. So here's a tricky true-false question. 23 is false. You are not, if your income is below your standard deduction and your personal exemption, you are not required to file a tax return. You probably would file a tax return low if you had, say, $5,000 worth of W-2 income and they withheld $200 from your paychecks. In order to get that $200 refund, you have to file a tax return. So this idea that you would never file a tax return, that's what makes it false. And so that's a difficult true-false question, because if you just go at it too quick, you go, well, you're not required to file one, which would be true. You're not required to file one, but that doesn't mean you would never file one. There are reasons why you might file one. As a side tangent, another reason why you might file a tax return, even though you feel like you didn't need to, is because you wanted to have the statute of limitations run. So the statute of limitations on a tax return is generally 3 years. And so let's say you, you sold a piece of property. You had no other income, but you sold a piece of property and it generated a $10,000 capital gain that wouldn't be taxable. If you want to make sure that they can never really reopen that transaction and look at it, you want to file a tax return, report it, show that you owe no tax, and then within 3 years, the statute of limitations runs out and they can never really re-ask you about that particular issue. If you do not file a tax return, then that statute of limitations is open indefinitely. And so sometimes, we don't encourage people to file tax returns if they don't need to, but if they have some little issue that is maybe open to interpretation, sometimes you want to file just to make, just to show that you filed and let the clock start ticking. Let's see. Well, the rest of them kind of bore me there. Casualty losses. We won't have a chance to talk about casualty losses tonight, but I will provide you with a short, I think it'll take about 15 minutes, but I'll provide you with a short video, additional one before the time of the midterm. Alternative minimum tax. one thing that you should probably review that I think is a good use of your time is the filing status requirements. And so this idea of who's single, who's head of household, who's married filing separately, who's married filing joint, and then when do we have the qualifying widow. And so there are these situations, and the common one that we try to ask people about is like, well, what if your spouse dies? Well, in the year they die, you can still be married filing joint. But then what about the next year? Well, the next year, if you're maintaining a house for dependents that are children, then you can be a surviving spouse or a qualifying widow. But you have to have dependents, and those dependents have to be minor children. They can't be adult children who are in college, for example. And so those reviews of the filing statuses, which is something we did kind of way back in the beginning, not that it's all that far back, that's worth a little extra time looking at. Effective tax rate, that's the tax that you owe at the end, your tax liability divided by your total income, which is different from your marginal tax rate. Your marginal tax rate is the tax bracket that you're in, what you're going to be taxed on the next dollar that you earn. And they are different because of the deductions above the line and below the line, also by excluded income, and then they're also different because of credits. And so all of those four things can kind of make your effective tax rate different from your marginal tax rate. Schedule A stuff, I'll skip that one because we'll get into that tonight. And so that's just a quick review of that midterm and kind of get you in the mode, or get you, I guess, just comfortable with the question style. I think it's important that you kind of know what to expect. So that takes me to, let's go to the Schedule A, because that's the topic we want to discuss tonight. And so we have been working with filing status. We've been working with the definition of income. We've been working with items that are excluded. Last week we did deductions above the line. I provided you with a video with some information, just some general information about some of the more common credits. And so sort of the last thing that we have to tidy up, I guess, in the foundation of individual taxes. I mean, there's certainly a lot more to cover, and we have more to do in the second half of the term. But if you were to think about that tax formula where we have, income broadly conceived, less deductions above the line gives you AGI, minus the standard or itemized deductions. We know something about all of those things that I just mentioned, except for the itemized deductions. And then we subtract the exemptions, which we know something about that because we know about personal dependency exemptions. And then you could subtract from your tax liability your credits, and we know something about those because we've been working with those. So itemized deductions, kind of the last thing in the formula that's vague to us, I guess. So the first thing to realize is that you need to have your itemized deductions exceed your standard deduction in order to make it worth being itemized. I think I mentioned before that the common things that help people get to the ability to itemize is having a home and having mortgage interest and property taxes. So that's kind of the common scenario when you're dealing with a taxpayer. As you look and you say, well, do you own a home? Do you pay, did you get a 1098 with mortgage interest on it? And then do you pay property taxes? And if they answer yes to those two questions, then there's, you probably are going to look a little bit deeper to see whether or not they need to itemize. Sometimes people can itemize without those two items if they have very large medical expenses, or if they have very large state income taxes, or if they have, if they've made a very large charitable contribution. But it's usually the mortgage interest and the property taxes that get you there. Approximately 25% of the population that files a tax return can itemize. It varies from year to year, 21 to 26%, but we usually say, a quarter, 24% or so is kind of the number. Part of the tax reform that we have just experienced is an attempt to try to diminish the importance of Schedule A. They think about a third less of the people will be able to itemize in the future. So maybe dropping this from around 24% to maybe just 16%. And the reason for that is a couple of things. The miscellaneous itemized deductions are going away in the future. And so I have not asked you any questions about that on the midterm. And so when you're reading, you can kind of gloss over that and not spend a lot of time on it. But the other reason why these itemized deductions or Schedule A's are going to be diminished in the future is the standard deduction is being substantially raised. So I don't recall off the top of my head, does anybody have a 1040 in front of them? Oh, never mind. I can answer the question here. The standard deduction for 2017 for a married filing joint person is $12,700. In 2018, instead of being $12,700, it's going to be $24,000. And so those people who are between $12,700 and $24,000 in itemized deductions will no longer need to itemize next year. And so that's how they're getting at sort of wiping out a third of the people that need to do the itemized deductions. Most of the time, when you are just sitting around your favorite pub, having a non-alcoholic beverage and chatting with your friends, and people start talking about taxes and start talking about things being deductible, for most individual taxpayers, they're usually referencing or thinking about something that's on the Schedule A, not knowing that 3/4 of the population can't do that anyway. And so this is, this is a little bit confusing to the general population. So with all of that sort of background said, let's jump into the Schedule A now and talk about some of the specific issues. So the first one here is medical and dental expenses. So we can't deduct all medical and dental expenses. We can deduct the expenses that are in excess of what we generally refer to as a floor. And the floor is 7.5%. And this is really interesting here. If you look, I'm looking at my text simultaneously, and if you look on page 5.4 in your text, you will see that their Schedule A has a 10% floor, and this Schedule A has a 7.5% floor. And that is not a mistake. The 7.5% floor is the correct floor. It was 10, but when we had the tax law change, they reduced it back to 7.5, and they implemented that item early. I know it's quite confusing. I will try not to ask you a question that makes you interpret, like which floor to apply. But let me talk about how this works. So if I have adjusted gross income of $10,000, which is not a very high adjusted gross income, but I like that number because it's an even number, then if we're using a 7.5% floor, I can only deduct my medical and dental expenses to the extent that they exceed $750. So if I have $1,000 worth of medical expenses, I'm going to end up on line 4 with $250. So that's how this floor works. The idea being that we're all going to have some medical expenses, medical and dental expenses. That's expected that we all have a certain amount. We're only providing people a tax benefit when we feel like they have a large amount, like they've had some significant unhealthy circumstances or something has happened and that they've overcome 7.5% of their AGI. So bear in mind, if you have a married filing joint company and they have a married filing joint couple and they have $100,000 in AGI, then the first $7,500 of medical and dental are not deductible. It's only when they get beyond $7,500. So what happens here a lot of times is people will have all their medical receipts and we'll add them all up and we'll put them in there on line 1, and then when we subject them to the floor, they end up with nothing. It's not always the case, and sometimes you don't know that that's going to be the case until you know their AGI and you know the sum of their medical expenses, so you have to go through the exercise. So let's talk about, so that's how the floor works. Let's talk about what can go on line 1. Line 1 can include a bunch of things that you and I might not normally think of. It can include doctor's visits, which you probably would think of, dentist visits, prescriptions, hospital stays, labs and tests, diagnostic activities. It can include durable medical equipment. So if you have to buy a walker or a wheelchair, it can include things like if you have to put a ramp on your house so that you have a wheelchair ramp. It can even include the cost of retrofitting a van for a wheelchair lift if a taxpayer needs that because of a medical condition. It can include the cost of your health insurance if you have to pay for it yourself. It can include the cost of your health insurance that you pay out of pocket if it's out of tax. So maybe your employer is paying for most of your health insurance, but you have to contribute $200 a month. Well, $200 a month times 12 is $2,400. That can go into the calculation for line 1. What line 1 can't include? Line 1 can't include items that are delivered by a non-licensed professional. So I can have, in line 1, I can have things like physical therapy. I can have in line 1 a massage if it's delivered from a an LMT, I think, which is a licensed or LPT, licensed massage, LMT, the licensed massage therapist. So I couldn't remember the initials. So the trick is are they licensed? You could include acupuncture if the person is licensed. And that license needs to come from some medical board at the state level. And so some states probably license acupuncturists and other states maybe don't. You can certainly include chiropractors because they're licensed. Other things that you cannot include in line 1, non-prescribed drugs. So if your doctor says, hey, I want you to take a bunch of vitamin C or, potassium or something that you can buy over the counter, since it's not prescribed, then it is, you can't be included in line 1. You can't include in line 1 things that are unnecessary. So if, I don't know, say you just want to become fitter and so you join a gym and then you join a weight loss program to lose some weight to try to generally improve your health, which are both great ideas, by the way. But because they're not really prescribed, you're not under the care of a medical person, those are not included in line 1. You generally can't put a hot tub in line 1 just because you want to, but if you legitimately have a back condition and you can get your doctor to write a prescription for one, your doctor is a licensed professional medical person, and if they write the prescription, then you probably can. But you're going to need, sort of some documentation on something of that nature. Any questions about specific items that maybe come to mind for people, or any of the what ifs that might be thrown in there? Hearing nothing from the crowd. Insulin, diabetes medication, all of those things could go in line 1. If you're paying for your own Medicare supplement, that can be dropped into line 1, not the portion that is taken from your Social Security because that's pre-tax, but if you're paying for a Medicare supplement, that can go in line 1. Eyeglasses, vision tests, those can all go into line 1 as well. So that's the medical piece. You collect it all together, you get all the receipts, you identify which ones are deductible, you add them all up, you get them into line 1, you subject them to the floor, and then you see where you're at with line 4. So taxes. We don't really pay much in the way of local taxes in Oregon, but we do pay state income tax. There are states around the nation that have local income taxes that are in addition to their state income tax. One of the states that I'm familiar with that does this is Maryland. And so in Maryland, they have a general state income tax, and then depending upon which county you're in, you check that, and then the county has a tax that is in addition to the amount that goes to the state. It's just a different way of funding county government. Here in Oregon, we fund county government primarily with property taxes and with general fund disbursements from the state, and then also from timber revenues. In other states, you know, they may have a lower property tax and do more with an income tax, and so then they may have a county income tax that comes into play there. For those areas where there's a sales tax, and so you know, you guys are in, or many of you are in Pendleton, or you are out there in northeastern Oregon. If you go across the border into Washington, they have a sales tax. If you go across the border into Idaho, they have a sales tax. In Washington, by the way, they do not have an income tax at all. If you go to California, they have a sales tax. So if you're in a state that has a sales tax, you can add up all your sales tax receipts, which, let's face it, nobody would do that because that's like too much work, because it's, you know, every time you went to get fast food, there'd be a tax on it. Unless maybe you like bought a car or a boat or some big ticket item, and then you might keep the sales tax for that one big ticket item. So you can either add up all your receipts, or they'll allow you, the IRS has this method that they will allow you to use based on your income. They'll give you a way to numerically calculate or estimate what your sales taxes are. You take the larger of the two, the larger of your income taxes or your sales taxes. Now here in Oregon, because we don't have a sales tax, it's always our income taxes. And it's not just the tax that you owe, it's all of the cash that that came out of your paycheck or that you contributed to the state during that calendar year. So let's talk about 2018. So let's say I file my 2017 taxes, and in April of 2018, I write a $1,000 check for last year's taxes. And then I have $10,000 withheld from my paycheck during the course of the year. This makes me sound like I make a lot of money. I'm feeling very happy all of a sudden. Well, now that's like $11,000 in state income taxes. So we would put $11,000 on line 5. So it's what you paid with your tax return plus the amounts that were withheld from your paychecks. And then if I had made quarterly estimated payments to the state also, it would be those items as well. So we have to look beyond just what a person's tax liability is and come up with all of the, all of the cash that left their hands for the state during the period. If we deduct our income taxes on the Schedule A line 5 in 1 year, and then next year I get a state income tax refund, that refund is going to be income next year because I got a deduction for it in the prior year. We talked about that a little bit when we were talking about items included in income. So that's the state income tax issue. That's, for us, that's a really simple and clear thing. It's usually just what did you pay with last year's taxes and then the number that's on your W-2. And we're just looking at income tax in Oregon because we don't have the others. Real estate taxes are the property taxes that you pay, for a home or for a condo or, a piece of realty, I guess. And you're allowed to take all of your real estate taxes. So this is not limited to just your principal residence. If I have a principal residence and then I buy a condo in Sun River or in Eagle Crest or over on the coast at, Salishan or someplace like that, I can deduct the property taxes on the additional pieces of real estate that I have. And so the real estate taxes would go on line 6. And again, for most people, we just have their state income taxes on line 5 and then their place where they live on line 6. And then we're good with this section and we're out of there. Line 7 is for states that have personal property taxes. We do not have any in Oregon that are non-business related. We have a personal property tax on fixed assets for businesses, but we're not talking businesses at this moment. The only place I can think of that really has a personal property tax is Florida. Florida will tax you on the value of your yachts and your jewelry. And it works just like a real estate tax, where they say, okay, what is the value of your yacht, and what's the value of all your jewelry, and what's the value of all of your art, and then based on that value they will assign a tax rate and then charge you a tax. So that is what line 7 is for, but we don't ever use it here in Oregon. And other taxes would be, I don't know, just if you had some other crazy tax that didn't fit into those particular categories. In 2017 and prior, lines 5, 6, 7, 8, and 9 could add up to however much they added up to. There was no cap on them. In 2018, under the new tax law, the maximum amount that can go on line 9 is going to be $10,000. You will hear, or maybe you have heard, this talked about a lot. That is going to be a barrier, I guess, for people who live in states that have fairly high taxes and fairly high real estate or property taxes. In particular, it will be very difficult for people that live in California, because property values are high and so assessments are high, so property taxes are high, and then because they have an income tax to go with that, it'll also be very difficult probably on people in New York. And so there was a lot of, when that law was changed, there was, lots of discussion about those and whether or not something should be done. But as of right now, the cap for 2018 will be $10,000. It can impact Oregonians if you, if you have a $400,000 piece of real estate, your property taxes might be getting close to $5,000, depending upon the county that you live in. And then if you combine that with, say, a household income of $120,000, $130,000, you're probably going to have state income taxes and property taxes that are going to go beyond the $10,000 mark, and you may be limited in 2018. Remember that I will try not to ask you any 2018 questions on the midterm, since our book is 2017. We won't project into the future. We'll talk about how things work. So interest, lines 10 through 15. There's a few things here. So the line 10 is the big line. This is your home mortgage interest. So if you have a house and you recently bought it, many of you have probably seen amortization tables where almost all of your payment in the beginning goes to interest, and then by the time you get to the end of your 30-year mortgage or your 15-year mortgage, most of the payment is going to principal. And so in the beginning, there's a lot of interest, and so that interest for the year is accumulated on a Form 1098, and the sum of that interest goes on line 10. This can be for your principal residence and for one other property. And that one other property can be any one other property. It could be a property that you buy so your parents could live in it. It could be a property that you buy so your kids could live in it while they're away at college. It could be a second vacation home. It could be the second property could be an RV that you live out of or have the potential to live out of. So I guess that brings us to, well, what is the definition of a home? And to be a home, you have to have a kitchen and a galley. Maybe those are the same things. You have to have a kitchen and a bathroom. Those are the two things that you have to have. So many RVs have a kitchen and a bathroom, and so they can meet the definition of being a home. And if you just have one home and one RV, it's possible that you could call your second RV a second home, and to the extent that you have interest on that, it may be deductible. On your principal residence, the maximum, or actually on on the whole total there, the maximum amount of indebtedness that you can have is $1 million. So if I have a $800,000 loan on my home, and then I have a $500,000 loan on my condo in Hawaii, I wish on both, by the way, then $300,000 of that debt is not deductible. So it's only the first $1 million worth of indebtedness for your residence that is deductible. That can be a problem in some states where property values are very high. Beyond that, you can then have $100,000 of non-acquisition debt that is just a line of credit. And so you may have heard people talking about home equity loans or HELOCs or other lines of credits and the mortgage interest being deductible on those. And that is true up to $100,000. In 2017, it does not matter what you use that money for. So you can use a second mortgage to buy a car and make your car interest deductible if you have the equity in your home and a lender is willing to do that for you. That is only true in 2017, Lo. In 2018, the $100,000 line of credit will still exist, but it will only be for home improvements. So it won't extend to other types of debts. So I suppose if you, I don't know, if you did a $20,000 remodel on a line of credit, you could probably deduct the interest on that in 2018. But for now, $1 million plus $100,000 equity line of credit. And so those are lines 10 and 11. All of that interest normally goes on line 10. Line 11 is for when you do not get a 1098. This doesn't happen very often anymore, but you could actually buy a home from somebody and they could carry the contract and allow you to make payments to them with a stated interest rate. We used to call these land sales contracts. And so if you engage in a transaction of that nature where there's no bank to issue a 1098, then you put the mortgage interest on line 11 and you have to provide some information on who that interest was paid to on line 11 so the IRS can make sure that the interest income is reported by the recipient of that mortgage interest that you paid. Line 12 is deduction for points. So if you have points associated with a new mortgage, those are deductible on line 12. If you have points associated with a mortgage refinance, those are not deductible immediately. They have to be amortized over the life of the loan. I think that's more than you need to know. I'm not going to ask you about that. But just so you understand, if I go out and I put in an offer on a home and I buy a new home and there's $2,500 in points on the loan for the new home acquisition, the $2,500 is deductible immediately. If 7 years later, after I've owned the home for a while, I refinance the home and I pay points at that time, because it's not original acquisition debt, the points are supposed to be amortized over the life of the loan. So that sometimes is difficult, I guess. Mortgage insurance premiums, those are deductible on line 13. For those of you that don't know what that is, if you borrow money to buy a home and you put less than 20% down, so let's make the math simple. I buy a $100,000 home. Normally you would expect a $20,000 down payment and you could borrow the $80,000. If I only put $10,000 down and I borrow $90,000, I'm doing what's called a non-conforming loan, which generally requires that the bank purchase mortgage insurance to make sure that if I don't pay, that the loan gets paid off. This is sort of a risk-sharing pool thing that goes on in mortgage lending. Well, that mortgage insurance is paid by me, the borrower, and so it's broken out, and that mortgage insurance premiums is deductible on line 13. Line 14 is for investment interest. You do not need to look at Form 4952. It's kind of beyond the scope of what we need to know. Where this comes into play, if you have a brokerage account, so E-Trade, Scottrade, Ameritrade, Morgan Stanley, trying to think of who else could do a brokerage account for you? But, one of these players where you're buying stocks and bonds. You may have heard that people can buy stocks on margin. They can borrow money from the broker to buy stocks. So that's the investment interest that we're talking about. So you can put investment interest on line 14 and it is deductible, but only to the extent that you have investment income. So let's say I pay investment interest of $1,000. As long as I have, say, $3,500 in interest income and $2,000 in capital gains and $3,500 in, stock dividends, then that investment interest is deductible. So it's deductible to the extent that I have income that exceeds the investment interest. If I just have investment interest and I did nothing but lose money in the market, then my investment interest ends up being not deductible. So it's limited to your profits or only to the extent that you have income. So that's interest. Gifts to charity. This is a tough area because this is an area where the taxpayer would like to abuse the system, and the IRS is aware of that and would like to prevent that abuse. And so there's a lot of, checking or extra paperwork that sometimes has to be done here. So generally, when you make a charitable contribution, it needs to be, first of all, to a 501c3 organization, which are things like the Red Cross, the Boy Scouts, the Girl Scouts, the Humane Society. So it's an organized charity of some sort. And then when you make a contribution to them, that contribution is deductible. If you make a cash contribution, that's clean and easy. They'll provide you a receipt, and that's deductible. That's great. It goes on line 16. You're allowed to make contributions of goods, so like household items, and we all are probably familiar with this. People take their household items when they move or when they get new things. They take them to the Goodwill or to St. Vincent de Paul or one of the other charitable organizations. That is deductible, but it's only deductible, it's not deductible for what you want it to be worth. It's deductible at the resale value in the thrift store. So let's say you want to, this is really going to hurt. Let me apologize in advance. I'm sorry. Let's say you want to donate your textbook to St. Vinny's after the term is over. And so you go, gosh, I paid like $200 for that thing. So you're thinking, well, I'll take a $200 charitable contribution on my tax return. Well, you can't take what you paid for it. You can only take what St. Vinny's is going to sell it for, which is going to be $5. And so your charitable contribution deduction in that case is going to be $5. When your non-cash gifts exceed the $500 mark, now you have to start telling the IRS a whole bunch of things like, well, what did you give and what did you pay for it and who did you give it to and what's the address of the place that you gave it to and do you have the receipt and this other information. So these gifts of the drive-through things to the St. Vinny's and the Goodwill, those are policed a little bit more because the IRS knows that people want to exaggerate the value of things because it's the fox watching the hen house. It's in their benefit to exaggerate. Cash is easy because we're going to require a receipt and the charitable organization is going to give you a receipt for the exact amount of cash that you gave. Charitable contributions are limited to 50% of your adjusted gross income. So if I only have $10,000 in AGI, the maximum deduction I can take is $5,000. The deductions that I can't take because they're limited by AGI can be carried over into the future. Two kind of more complicated areas of charity. One is if I give stock. So let's say I buy stock for $5,000 and then 20 years later it's worth $50,000. If I sell it, I would have a $45,000 capital gain that I would have to pay tax on. But if I give that $50,000 worth of stock to the charity, I not only do not pay tax on the gain, but I get a $50,000 tax deduction. And so we would like to see, you know, if you're thinking about giving to a charity and maybe you're near retirement age and you have a portfolio of resources that you could use from, one of the things that you like to do is use appreciated stock for gifts because you get this double tax benefit in that situation. A more difficult situation, I guess, is when I get something in exchange for the gift I've given to the charity. And so this one always is like, you know, as a tax preparer, it just drives me crazy because I know the rule really clear, but the taxpayer doesn't understand. And so they pay $75 to go to the XYZ gala. And they get, you know, like the rubber chicken dinner and the entertainment and the two little coupons for free drinks. And then they, you know, they bid on silent auction items. Well, the charity has to tell you, of that $75 that you paid to go to this event, what is the value of that event? And so maybe it was $30. And so that's called a quid pro quo contribution. And the deductible amount is your contribution less the value of the benefits that you got. So since we said $75 ticket price, $30 value, your deductible amount is $45. Then what gets really difficult is people, you know, they bid on these items at the silent auction and they buy this condo in Hawaii for $1,000. And they think they have $1,000 charitable contribution. Well, if the fair market value of the condo rental is $2,500, they have no charitable contribution at all. It's only to the extent that you paid more than the value of the goods that you received. And so this one's kind of, you know, the people that go to these events a lot, they're kind of misinformed about them in a lot of cases, and they want to deduct the whole $75, and then they want to deduct the whole $1,000. And in the end, what they're left with is a $35 charitable contribution, and they think you're a bad guy because you're explaining the rules to them. So that's a bit about charity. Now, casualty and theft losses. What I'd like you to do is I'd like you to pull out, not right at this moment, but print yourself off a Form 4684 after we're done here tonight. And I'm going to provide you probably a 15-minute video on casualty and theft losses separately sometime in the next few days. They're not super complicated. It's not a really big item, but they're just unique enough, and it's worth having the form in front of you. And so I'll bring that form up, create a video, and pop that into Canvas sometime in the next few days. So watch for that to be coming. I'm not going to talk tonight about lines 21 through 27, and these are the lines that you don't need to read about in your text. These are called the miscellaneous itemized deductions. You might notice that on line 26, they're subject to a 2% floor, so you can only deduct these things to the extent that they exceed 2% of your AGI. These are gone in 2018, so lines 21 through 27 completely gone in 2018. This is one of the few places in the tax law change where they actually did achieve simplification. So these deductions, along with the 2% floor, are just completely gone next year, and so it doesn't make sense for me to ask you a lot of questions about something that's not going to exist in the future. So skip over that when you're reading, and don't worry about those for the time being. Other miscellaneous deductions, line 28. Two things go here. There's actually three things. The third one is so weird that it never comes up, and it's basically something about gain or loss on the refinancing of municipal debt, blah, blah, blah. I mean, it's so complicated and nobody ever sees it that it doesn't exist. But there are two things that go on line 28 that you may see someday. One is gambling losses. So if I win the Oregon lottery, let's say I win $2,500 in some jackpot or something, scratch it or something like that. I don't play the lottery, so I don't know how these things work. But let's say I win $2,500. Well, at that point, I have to report the $2,500 on line 21, other income, on the front of the 1040. But I can deduct all of my gambling losses up to my gambling winnings. So I can put something on line 28. bear in mind that if I can't itemize my deductions, it doesn't help to put anything on line 28. But when I have gambling winnings, I can sort of accumulate all of my gambling losses and put them on line 28. The other item that can go on line 28 that could potentially arise at some point is if you have, if the taxpayer has expenses that are incurred so that they can work or modify so they can work because they have a disability. It doesn't really make much sense to put that here on a line 28. I would sure hope that an employer would deduct that, but there's where it would go if the employer doesn't do it. So I'm thinking, I don't know, maybe speech recognition software or some other, an extra large monitor, or, I can't think of any kind of accommodation that we would do, that an employee would do, that we wouldn't ask the employer to pay for. And, the employer can always deduct it, and it's a normal business expense for them. And then it's just taken care of. Whereas if we have the employee do it, they can only deduct it to the extent that they can itemize, and then they're doing it with after-tax dollars. It's just a very difficult situation. But that's where it goes if it comes up. So you can see in this form then, line 4, line 9, line 15, line 19, line 20, 27, 28 are all added up on line 29. And then if our AGI is not too high, then line 29 becomes our itemized deductions. And to the extent that line 29 exceeds our standard deduction, then we take our itemized deductions. And so that's a quick rundown of deductions below the line, with the exception of the casualty expenses. Questions? Can somebody verify that you guys still exist and I'm not just talking to myself?
Yeah, we're still here. We're still here.
Are you like asleep now? Okay, so let's check in where we're at here. So we've talked about the midterm and we've talked about the deductions below the line. Some things that I've given you here, just to give you a sense of how these things become more difficult and more complicated. And, I think I mentioned that you can do like a 2-year master's degree in tax. You can spend a lot of time studying tax. I put a PDF article up on charitable contributions, and this is the situation that happens when, let's say, a farmer gives an easement so that the creek can have more trees next to it, so the riparian zone can be better, so that we can shade the creek to make the water cooler, so that we can have better anadromous fish populations, which I'm fully in support of, as you can tell by my very detailed description of that situation. But the farmer just, they gave some land, a wildlife easement. They didn't really actually give the land, but they gave away the use of the land so that specific things could happen on it. And maybe they're working with, the State Department of Fish and Wildlife or something to help achieve these goals or something. So they have a charitable contribution of some kind. How much is the difficult thing, because they didn't give up their full land, and they may not have given up their land forever, and so there can be a lot of more detailed rules. And so this charitable contribution of easements article, I would encourage you to skim, because it just kind of gives you a sense of where the future difficulties lie. And then the other thing that you have down here is you have a practice problem for Harry and Ginny, the Potters. Are you familiar with them? And so this is just a Schedule A. And I would encourage you to print out a Schedule A, print this problem, and try to knock out this Schedule A. It's not a whole tax return. It's just the Schedule A. I give you their AGI, 98,000. And then I give you some expenses and plug them into the Schedule A, the ones that they can go on a Schedule A, and see what you come up with. what I will do is, I'm hoping I can do this tomorrow, is I'll provide you with a solution to this problem. And so that will give you some feedback on your level of understanding with the Schedule A. So print this problem out, print that blank Schedule A, plug it together, and then watch for a solution to come in the next couple of days. Speaking of solutions, also, I hope to provide you with a solution to the Kennedy's tax problem. You guys turned that in. I graded them this morning. You should have scores now. A few people missed a few minor things, but I thought I would take my 1040 and upload that to Canvas tomorrow also, so that you can have that solution. So if you lost a couple of points on that problem, you can see. I tried to give you some notes in my comments, but you can see more specifically what the correct things look like. So here's the 3 things that you need to do this week. You need to watch for that casualty video, review the Kennedy problem when the solution comes out, make sure that you understand everything that was involved in the Kennedy problem, review the sample midterm. If you have questions about specific problems on that are unclear to you, you can message me about those. And then review the Potter's Schedule A problem, which a solution will be forthcoming on that in the next little bit also. And so do all of those things in prep for the midterm, and then don't do this until after the midterm. But you have the next tax problem. It's not due this week, but it's due the following week. And so here's Frank and Sandra Anderson. And one of the things about these tax problems, we just finished the Kennedys, they'll get a little more difficult each time. And so just bear that in mind, that they're going to take a little bit more effort. But let's just review this one quickly. Actually, let's not. I guess what I would like you to do is do those things. Do the Schedule A, do the casualty video, do the practice midterm, circle back on the Kennedys, and make sure that you're good with all of those things. So focus on those items this week, along with completing the reading, and then maybe review the dependency issues, and then review like the chapter summaries. And then print this Frank and Sandra Anderson's tax problem and start working on it Sunday. So do it after the midterm, but let's not confuse ourselves by adding this issue in before the midterm. So I'd like you to print this on Sunday, kind of get your tax forms out, and one good way to deal with these things is just to kind of indicate that, like, oh, this is a doctor, so that's a Schedule A issue, and this is life insurance premiums, and so that's not deductible, and this is a dentist, so that's a Schedule A issue. Just kind of make sure that you know what's what, and then when we meet again next Monday, let's have a Q&A about the Anderson problem so that you can go into preparing that well prepared. But let's not open that can of worms until after the midterm. So with that, I would like to shut up now and answer any questions that you guys have.
Will you be preparing solutions or things for the second midterm to know if we're on the right track with that?
Could you ask that again? You broke up a little bit, and I.
Will you be providing an answer for the sample midterm to see if we're on the right track before we take the actual midterm?
Sure, why not? You're correct that there is not one there, and so I will try to put that into Canvas also. All of these things that are going to pop up this week, they're probably not all going to pop up immediately, but let me do the midterm one first, and then I'll do the solutions and then the casualty piece. But I will provide you with all of them sometime during the week. Other questions? Well, I think one of the things that will be will be good after this week. You guys will have a very clear sense of where we're at in the second and the final. Very much like the first midterm. These tax are the same. They'll just get more complicated each week or each time you want it. And so I think you're starting to get a feel for the expectations now. And most people did quite well on the first tax problems. The few discrepancies were pretty minor. They're easily cleaned up. And so I think everybody is in pretty good shape. I would encourage you to devote the time this week yourself in some shape.
Mike is giving the feedback again.
Did it just start?
Yep.
Can you hear me now?
Yeah.
I switched over to my other in-system microphone, so that is interesting that it goes, maybe it only has like an hour time limit and then it gets all wonky. That's an official technical term, by the way, wonky.
Yeah, it's only been within the last like 2 minutes, so it's odd.
Interesting. What else can I tell you guys? How else can I be of help this evening? Well, hearing nothing, I'm going to stop the recording. I think we're officially done. I'll hang around a bit in case anybody has any other questions. But thanks for joining us tonight. And if you have, I'm available all week. Also, if you want to send me a message in Canvas or whatnot, I try to get back to those pretty quickly. So whatever I can do to help you prepare this week. And what I wouldn't do, here's one piece of advice. I wouldn't study tomorrow afternoon. I think it's going to be a little bit too sunny. And so make sure you study in the morning or after dark or something, and that you get out and enjoy some sunshine while it's good tomorrow. Thanks, everybody.
Thank you.
Yeah.